What if the biggest signal for crypto isn't Bitcoin's price? It's the economy breaking beneath the surface. Nearly half of Americans now say they're financially worse off than a year ago. Bitcoin supply and loss just crossed a level that's historically marked cycle bottoms. Meanwhile, XRP is seeing shrinking exchange inflows, growing ETF demand, new derivatives markets, and banking adoption expanding globally. So while fear is rising everywhere, is smart money positioning for what's next? Let's break it down. Nothing in this video is financial advice and is for information and entertainment purposes only. Always do your own research before making any investment decisions. Welcome back to Ledger Pulse, your source for the biggest developments in crypto, XRP, regulation, institutional adoption, and the macro trends shaping digital assets. Today, we're connecting several stories that may look unrelated on the surface: consumer stress, Bitcoin capitulation signals, XRP ETF inflows, new XRP perpetual markets, global banking adoption, and a potentially crucial update from Washington. When you zoom out, a larger picture starts to emerge. One of the most overlooked charts this week came from a new survey showing that nearly 44% of Americans say they're financially worse off than they were a year ago. That's the highest reading since early 2023. Think about what that means. Inflation may be cooling on paper, but for millions of households, affordability remains a major issue. Higher housing costs, higher insurance costs, higher debt payments, and growing economic uncertainty. Historically, periods of financial stress tend to create two reactions. First, investors move defensively. Second, they begin searching for alternatives that can outperform traditional assets. That's where crypto often enters the conversation. The irony is that some of the biggest opportunities emerge precisely when public confidence is at its lowest, and another metric may be suggesting we're approaching one of those moments again. Crypto quant analysts reported that Bitcoin supply and loss has now climbed above 50%. Historically, this level has coincided with major capitulation events and long-term market bottoms. Now, that doesn't guarantee a bottom is in. No indicator is perfect. But throughout previous cycles, periods where more than half of circulating Bitcoin was underwater often occurred near the end of major corrections. Why? Because weak hands get flushed out, fear reaches extreme levels, and sellers become exhausted. Those conditions have repeatedly laid the groundwork for future recoveries. This is exactly why veteran investors pay close attention to sentiment. When optimism is everywhere, risk can be elevated. When fear dominates headlines, opportunities often begin forming underneath the surface. Which brings us directly to XRP. Because while much of the market remains focused on volatility, some XRP metrics are quietly moving in the opposite direction. According to crypto quant data, XRP inflows to Binance have continued declining. That matters because exchange inflows are often viewed as potential sell-side liquidity. When fewer tokens move onto exchanges, available selling supply decreases. In simple terms, less XRP arriving on exchanges can mean fewer coins immediately available for sale. At the same time, whale activity remains relatively stable. If demand strengthens while available supply contracts, market dynamics can shift quickly. This doesn't guarantee higher prices, but it does suggest that large holders may not be rushing for the exits despite recent volatility. For XRP investors, that's an important distinction. Price action tells one story. Underlying market structure can tell another. And right now, the structure appears more constructive than many headlines suggest. Another notable development came from XRP spot ETF activity. While Bitcoin and Ethereum products reportedly experienced significant combined outflows, XRP ETFs recorded positive net inflows. The dollar amount itself isn't the main story. The trend is. Institutional capital is beginning to recognize XRP as its own asset class rather than simply a smaller version of Bitcoin. That's a major shift. For years, XRP's narrative was dominated by regulatory uncertainty. Today, the conversation is increasingly centered around utility, liquidity, payments infrastructure, and institutional adoption. Every time capital allocators choose exposure to XRP, it reinforces that evolution. And that evolution appears to be accelerating. One of the biggest XRP developments this week, Kalshi has launched XRP perpetual contracts for US traders. This is significant for several reasons. First, it's regulated. Second, it expands market access. Third, it creates additional liquidity pathways for participants who previously had limited options. The broader story here is market maturity. Institutional adoption doesn't happen overnight. It happens piece by piece. New products, new venues, new infrastructure, then, eventually, greater participation. Each additional regulated platform helps normalize XRP within traditional financial markets, and that's exactly what we're seeing. In another major international development, Japan's SBI Shinsei Bank announced a pilot program allowing customers to convert portions of their deposit interest into digital assets including Bitcoin, Ethereum, and XRP. This is important because Japan remains one of the world's most crypto-friendly major economies, and SBI has long been one of Ripple's strongest strategic partners. The significance isn't necessarily the size of this pilot, it's what it represents. Traditional banking institutions are continuing to experiment with integrating digital assets into everyday financial products. Every pilot program creates familiarity. Every successful implementation reduces friction. And every step brings digital assets closer to mainstream adoption. Regulation remains one of the biggest variables facing crypto markets. This week, reports emerged that negotiations surrounding key Senate discussions remain active despite some disagreements. While details continue evolving, the larger takeaway is that lawmakers are still working toward frameworks that could bring greater clarity to digital assets. Markets generally prefer certainty over uncertainty. Whether regulations end up more favorable or more restrictive than expected, clear rules often help institutions participate with greater confidence. For XRP specifically, regulatory clarity has always been one of the most important long-term catalysts. The closer the industry gets to defined rules, the more comfortable large financial players may become engaging with the space. When you combine all these developments together, an interesting narrative emerges. Economic stress is increasing. Investor sentiment remains fragile. Bitcoin is flashing historical capitulation signals, yet beneath the surface, XRP exchange inflows are declining. ETF demand is appearing, regulated derivatives markets are expanding, banking adoption is growing, and regulatory conversations continue moving forward. That's not the profile of an ecosystem standing still. It's the profile of an ecosystem quietly building. The market may not be rewarding every development immediately, but infrastructure tends to arrive before price appreciation, not after. The biggest moves in financial markets often happen before the majority notices them. Right now, fear dominates much of the conversation, but beneath that fear, crypto infrastructure continues expanding, and XRP remains at the center of many of those developments. Do you think XRP is quietly positioning for its next major move, or does the market still need more time before adoption translates into price? Let me know in the comments. If you enjoyed this breakdown, make sure to like the video, subscribe, and turn on notifications so you never miss an update. If you want to dive deeper, check out these videos here. Thanks for listening, and we'll catch you in the next one.